Good morning and welcome to the CT Private Equity Trust PLC Q4 NAV update and full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received in the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Christine Cantrell. Good morning.
Thank you very much. So we're delighted that you can all join us today. I'm the Head of Investment Trust Sales here at Columbia Threadneedle, and my job today is really just to moderate the Q&A, and I really do hope that you take this opportunity to ask both Hamish Mayer, the Fund Manager, and Andrew Carnwath, the Deputy, any questions that arise during the presentation or that you have at the back of your mind off season. So submit them and I'll get to pose as many of them as possible to the Fund Managers at the end of their presentation. Thanks very much. I'll hand over now.
Thanks, Christine, and good morning, everybody, and thanks for joining this presentation of our 2024 full year results. As Christine mentioned, I'm Hamish Mayer, Head of Private Equity at Columbia Threadneedle Investments. I'm also joined by Andrew Carnwath, who's a director in my team and is now the Deputy Manager of CT Private Equity Trust. I'll just say a few words to give you a sketch of the company, first of all, and then we have a presentation that takes you through the key points of the latest results, which we'll go through fairly quickly, but obviously anyone who has questions, just submit them, and we'll try and leave a good amount of time at the end to cover off all the questions. Andrew and I will be doing the presentation, just sharing it between us. So first of all, just a bit of background on CT Private Equity Trust PLC. It's been going for over 25 years. It invests largely in lower mid-market buyout in Europe with a small amount in North America. We basically have a portfolio that consists of direct holdings, co-investments, which is currently 42%. Aim is to get to about 50%. And the balance of the portfolio is invested in a range of private equity funds, also across the European mid-market and a few others beyond that. This mixture of direct holdings and fund positions, I think, positions us at a good position in the risk-reward ratio, where we have a naturally well-diversified portfolio with well over 500 holdings. Nearly half the portfolio is in co-investments, and there's about 40 holdings there. And each of those individual companies is, the holding is sufficiently large that if it goes well, it can move the needle very positively. If something goes badly wrong, it's not going to completely spoil the party for us. And then we have this broadly diversified, high quality portfolio in all the funds as well. And we get, excellent returns from both elements of the portfolio. So let me just take you through the highlights of the results for 2024. First of all, 2024 was a year of transition. Obviously, there have been quite big changes in the world in the last couple of years, which has had a bearing on the private equity market. I mean, interest rates have gone up a lot. There have been a number of external changes in the international environment. We had a number of very strong years before that, and so we have been essentially running through about 2 years of adjustment, and we think that the situation that we're in now is that many of the ingredients for recovery are in place. Interest rates appear to have peaked; they've come down slightly. There's still plenty of appetite for private equity. There's been a bit of adjustment in pricing in the market. The banking environment has improved significantly, and we see plenty of signs of recovery. And indeed, within our own portfolio, Realisations, which is a good measure of the confidence levels in the private equity market, we're up 76% in 2024 compared with 2023. Our NAV total return in the year was 4.6%, which doesn't sound that spectacular, but it is better than we achieved in 2023. It's a bit lower than I was expecting. I didn't expect us to rebound back up into the teens, but I thought we might do, a couple of percentage points better. But what we've seen is that certainly since November, when we last did a presentation on this, there has been a bit of a change in the environment where confidence in the business sector, consumer, both here in the UK and elsewhere, has taken a bit of a knock, and that has tended to postpone things and postpone exits, postpone deals. Deals that were in train have taken longer, sometimes being completed at lower values. Other deals not happening at all, or the buyers and sellers not coming together, which is typical in the private equity industry, where there's a bit of a dampening effect on confidence. And I think that probably has had an effect in the final quarter's NAV, which, although it was up quite strongly, we still had just 4.6% increase in the whole year. That said, it is an increase. We haven't gone down. We continue to make progress. We had, as I mentioned, good increase in realizations in the full year, up 76% on the prior year at 108.6 million. It's only the third time we've been ahead of 100 million. The dividend's been maintained at 7.0 pence as a quarterly dividend. That's actually, if you add up all the last four dividends, that's a good increase on last year. And that offers an excellent yield of nearly 6% based on the share price. Just move on. There were a number of noticeable exits during the year. We sold Jolly's, which is a pet shop chain. This is a deal led by Kester Capital, lower mid-market buyout group in the UK that we've been backing for a number of years now. Jolly's is the number 2 pet shop chain in Britain behind Pets at Home. And during the tenure that Kester were in charge, the business improved very significantly. It went from basically a relatively sort of undermanaged former family business to being, much more efficient. They introduced third-party distribution. They significantly expanded their stores from 60 to about 100. Increased their profits significantly as well. And so this was sold out to TDR Capital, who also own Asda, for over 4 times the money and 27% IRR, 27% annualized return. So a really good outcome there. It was a 6-year hold. This hold had gone all the way through the pandemic and out the other side. The pandemic was actually a good thing for Jolly's because pet shops, as you probably remember, were open all the way through, and lots of people went off and bought dogs and food for the dogs. I didn't actually, but nearly everybody else did. Next holding is Coretrax. This is a wellbore plug and abandonment business based in Aberdeen. We were in this for 6 years also. Buckthorn are the lead on this deal. They're specialists in energy. Now, what does wellbore plug and abandonment mean? It's basically equipment that goes on the top of an oil well, which you use to cap it off. Either if you've finished using it completely, or you finished it at that particular stage in the exploration process. So it is, the demand for their services is connected to the oil price, so it can be quite volatile. And the oil price was volatile during the holding period here. However, this business has been significantly expanded. They acquired another company in America called Mohawk, which gives them very valuable exposure to the Permian Basin in the States. And it was sold to Expro, which is another oil services company, a listed company, incidentally one that was private equity backed originally, and we actually had shares in it through Candover about 20 something years ago. Anyway, they've bought it, and we got 1.7 times cost and 11% IRR, which is it's not an ideal return, but it's a perfectly reasonable return given the circumstances. Thirdly, another Kester Capital deal was the exit of ATEC. So ATEC is an insurance broker and managing general agent, which specializes in a small number of personal lines. So it does little caravans, small boats, beach huts, which are obviously niches, but that makes them more profitable. And Kester put in a lot more management into this business, digitalized a lot of the processes, and the net effect is it has grown very substantially over the 7-year hold. Profits quadrupled, and they were able to sell it to Perwin, which is another private equity firm whom we know, made over 4 times cost. So that was another excellent return, a really good vindication of our decision to back Kester many years ago. They've really come through with some excellent exits. So those are the 3 significant large exits during the year, and they'd all basically taken place in the first half. The second half was quieter from that point of view. This shows you the long-term progression of NAV and dividends. Just to remind you, we pay out 4% of NAV as dividend each year. It's paid in 4 quarterly installments, where the dividend is based on the average of the last 4 quarters NAV, except where that number comes to be below the previous dividend, in which case we maintain the previous dividend, which is what we've been doing at the moment. So it's an upwards only policy. The policy's been in place, as you can see, since 2012. And this has resulted in us returning £143 million to shareholders through dividend over that time period, which is pretty substantial if you consider that the overall company even now is only 500 million. It also makes us what's known as a next generation dividend hero by the Association of Investment Companies, because we've grown our dividend every year for 10 years. And so we sincerely hope to maintain that record, and eventually we'll become an actual dividend hero. I think we have to do 20 years of growth for that, so it's a few years out yet. And this is the long-term return of the share price total return, NAV total return. The share price total return is lagging the NAV total return at the moment by a sort of unusually wide margin, because we're on a discount. That we would expect to close that. Long term is you get a very similar return from the shares as you do on NAV. And obviously we've massively outperformed the stock market over that time period. That's a full 25 years. We expect to do that because you're taking higher risk investing in private equity, and you should be properly compensated for that risk, and our shareholders have been. There's just other ways of looking at the performance. You can see at the bottom the individual years. So we've had 2 sort of, if you like, quietish years after a number of strong years. And we would hope that 2025 would revert back to being one of the stronger years. In terms of outstanding undrawn commitments, these are the commitments we make to private equity funds. We have to do that in order to make sure that the proceeds of realizations are properly redeployed. And we're currently at 193 million, which is bang on the average. It's a perfectly normal situation. Here's the debt. We net debt of 76.5 million, and that is also in a kind of normal range. We're using about half of our borrowing facility at the moment. We do believe very much in the benefits of gearing, that the returns that we expect to make from investing in private equity will, over the medium term and longer term at least will far exceed the cost of borrowing, even now when borrowing is more expensive. And so it makes sense. We have a very well diversified portfolio. The banks are prepared to lend against it, and the investment trust, closed-end structure, lends itself very well to the use of gearing. Typically, gearing would be between sort of 10 and 20%. Towards the upper end of that range, you look at that as sort of temporary. And similarly, if it dips below 10%, we'd like to be geared rather than ungeared because of the benefits that gearing actually deliver. So this is basically a list of new investments that we've made in 2024. I'm not going to talk through every single one of those. A couple of them we'll go into more detail in a minute. But we're always making new investments, funds, co-investments, and that has continued on into 2025. That's these are individual co-investments or fund commitments. We've got a few slides here which describe some of the more recent co-investments. I'm not going to go through all of these now. I'm going to concentrate on the last three, which are ones that we have not reported on before. Starting with Accounts IQ, which is a co-investment we've done alongside Axiom Equity. And I'm just going to ask Andrew to talk briefly about this one and the next two.
Great, thanks, Hamish. So Accounts IQ is an Irish software company, and as Hamish mentioned, we've invested in that alongside Axiom. Axiom's an emerging manager that's been set up by some experienced executives that we knew very well from their previous positions, both at Inflection and also HG Capital. So Accounts IQ provides cloud-based accountancy software to medium-sized businesses. And we think that's a very attractive market. It's a mission-critical software, mission-critical service that they provide. And it's targeting mid-sized businesses, which we think are currently poorly served by the sort of off-the-shelf SME solutions that are there, and then the large enterprise solutions that take a significant amount of investment to put in. So it's nicely differentiated product, growing very quickly, and as you can see on the slide, it's got some excellent sort of financial and software as a service metrics, and I'm pleased to say off to a good start. We also committed to Inflection Enterprise Fund 6. Now, this is the latest fund raised by Inflection, who you may know are a long-term investment partner of ours. We've been investing with Inflection for over 20 years, and they have produced outstanding returns over that period. Their Enterprise Fund series targets the lower mid-market, and they define that as businesses with an entry valuation of 50 to 150 million. Now, we think that's a particularly exciting market. It's less intermediated, and you can find real value there and outsized returns. And a key attraction of this fund is the ability of Inflection to bring the resources of their wider group and their value creation team to these relatively small businesses, helping them to complete M&A, strategic add-ons, but also to internationalize and grow rapidly. And the third recent investment, Friendly, this occurred early this year, and it's a co-investment alongside Procuritas. So Procuritas, again, long-standing investment partner of ours. We've been in their last 4 funds, I think. Friendly is a Finnish business. It's an IT services business, And the investment strategy here is to consolidate the very fragmented market in the region. Procuritas formed the base company by acquiring simultaneously 10 smaller companies and putting them together. And then the plan is to continue to consolidate that market. We've come in at quite an interesting time. We think a lot of the heavy lifting and the work has been done. Procuritas has completed another 8 acquisitions. So it's put 18 companies together. And we're coming in at that point at less than the cost that it's taken to acquire the business. And at the point where we think the business is at a real inflection point, it's beginning to see the real benefits of that scale, the integration, the cross-selling. Relatively recent investment, but again, pleased to say off to a good start.
Good. Thanks, Andrew. We'll now look at the flow of realizations that we've had in 2024. There's a list on the slide here. I'm not going to speak about every single one, but just to make the point that the returns are good. You look at the money multiple and the IRR on the right-hand side. These are basically in just about every case really respectable numbers, and they are very diverse. They're from different lead managers, different geographies, and different sectors. You can see that quite a lot of the sectors are quite technology oriented, or sometimes a mixture of technology and healthcare. And that's because, between these two sectors, we have about half the portfolio invested there. And these are sectors of big interest to private equity because of the secular growth characteristics. So it's no surprise that that's where the realizations are. And that's continued on over the next page. And then it's also continued into 2025. It's obviously early days. It's difficult to know how 2025 will develop, but we've already had a number of good exits. And then on the other side of the equation is the company's making new investments all the time, either with through the funds, where the funds draw down money for new deals, or through the co-investments, some of which we've described. So if you look at this, there's some add-ons to our co-investments, but there's also drawdowns from the fund, again, into interesting niche businesses, geographically diverse, and a number of different lead managers. And this all, adds to the strength of the portfolio. And that has, that's continued on into this year. This slide just shows you the long-term record of distributions and drawdowns. You can see there is an element of cyclicality here. When drawdowns go up, so do distributions, and vice versa. We obviously can control the rate of co-investments more precisely than we can the drawdowns from the funds, but then we have a good idea of how funds are going to draw down, so we can have prior awareness of what the cash flow is going to look like, and we model that and have done successfully for over 25 years. This is the largest underlying holdings. I'm just going to ask Andrew just to comment on a few of the more significant ones.
Yeah, so up at the top, you can see Sigma. Those of you who have been on these presentations before will recognize that name. So Sigma, electronic components manufacturer. It's been in the portfolio for a while. It's just paid a nice dividend, and we're beginning to look at sort of exit options there. Second, Weird Fish. This is a casual clothing manufacturer in the UK. And those of you who came to our Capital Markets Day would have seen the CEO of the company, the new CEO, present. It's performed exceptionally well, record results in 2024, and hence it shot up the holdings to number 2. And I'm pleased to say, despite very difficult conditions at the start of this year for retail, it continues to perform very well. Third in the list is TWMA. So this is another investment alongside Buckthorn, an energy specialist, the same as Coretrax. And again, that's an investment that's coming to maturity, and we're looking at exit options. Another name that you might recognize is the 6th one, Hoffi. So this is a consolidation of the funeral services market in Italy, and that owns San Zero, which is the leading funeral house in Italy. This has been an exceptional investment for us. We realized 75% of the investment at over 8 times our money, and we reinvested 25%. That continues to grow very well, both organically and through acquisitions. And then number 8, a sort of newer name on the top 10, Amethyst. This is our pan-European consolidation of radiotherapy provision for cancer. Really nice business, making a huge difference to the lives of people across Europe, and growing very, very nicely, both by building new greenfield sites, but also through acquisition, buying older facilities, updating the equipment, and enabling the company to give much better cancer care.
Great. Okay, thanks, Andrew. The next page, it gives you some statistics on the co-investment portfolio. So Andrew, do you want to just run through this again?
Yeah, I think the key points I would take from this slide is the robust growth, both in revenue and in EBITDA. So revenue growth of 20% for the year, which is very encouraging and solid. And then the EBITDA growth a bit above that, 24%. And that's especially encouraging as it shows that the margins are improving. Those margins were under pressure for a while as we went through a period of inflation. And so it's really nice to see the margins coming back and that EBITDA growing nicely. Also on the slide, you can kind of see the average and the median revenue and EBITDA of the portfolio, which gives you a good idea for the sort of size of businesses that we're investing in. As Hamish said, these are established niche market leaders, but they're still relatively small companies, and therefore they've got the ability to grow rapidly.
Excellent. So just looking at the underlying movement in the underlying holdings, we've had 48 exits during 2024, and there'll be 75 new companies. So the portfolio, it's over 500 million, extremely well diversified, which we think is a great strength. And then just looking at those exits, the average uplift on exit, so that's the exit price compared to the latest valuation, was 23%, which is pretty respectable. It's a bit lower than it was last year, but it's still, what you would be aiming for. You expect when you sell a company that you get more than the valuation that we hold it at, partly because our valuation methodology is inherently conservative. But secondly, you're obviously swapping an illiquid share for cash or liquid shares, so you'd expect a premium. And 9% of the companies in the portfolio exited during 2024. So quite impressive numbers there. Realizations are important to track because of this feature, that realizations are generally at a significant premium. So the more realizations you have, all things being equal, that should boost the NAV. Now, it's obvious all things are not equal, so it's not a simple relationship, but it is a very useful indicator to look at. And over time, when you have strong bursts of exits and realizations, that will usually correspond, not necessarily exactly contemporaneously, but will correspond well with growth in NAV. So worth monitoring that. Who was actually buying it, buying the companies? Well, about half go to the trade and half go to other private equity firms. That's kind of the long-term picture. That hasn't changed significantly. So, selling to trade and private equity, just sometimes the private equity actually are also trade. They actually are companies in the same sector, but that are themselves backed by private equity. But there's a healthy private equity industry out there. They particularly like to buy these lower mid-market businesses that are in our portfolio where they've already had some private equity involvement. The businesses have been professionalized, and they can be great targets for the bigger private equity funds. In terms of the geographical split, it's by exit. 2/3 of the exits were in the UK. So people are always going on about, there's nothing happening in the UK. Well, that's not actually true. There's plenty going on in the UK, and in fact, that's more than its fair share for this portfolio. There's about 42% in the UK, but it's 2/3 of the exits last year. If we just look on the next slide, in terms of the geography of the portfolio, it's actually 41%, out by 1% in the UK. This makes us the most UK oriented of the private equity fund of funds that you can buy on the stock exchange by some margin. Britain is the largest, longest standing and deepest private equity market in Europe by some way. And it's obviously our home market, so it makes sense for us to be involved significantly there. Most of the rest of the portfolio is in continental Europe, but we do have 17% or so in the US, which consists of a number of long-standing key relationships with associated co-investments, which has delivered well for us. In terms of the age of the portfolio, about half of the portfolio is over 4 years old, nearly 2/3 over 3 years old. Most private equity deals are organized around a 4-year hold. Sometimes it's longer, sometimes it's shorter. But if everything's going according to plan, after about year 3, plans for exit will be quite well advanced. So this monitoring the age of the portfolio gives you an idea of how much mature stock, if you like, is coming through, ready for exit. And the answer is that we always have a significant element coming through, which is why we tend to have significant realizations every year. We don't tend to have a sort of feast and famine situation. It tends to be quite steady and rising in tandem with the size of the company. In terms of the valuation of the portfolio, if you look at the co-investment element, which is nearly half, which is representative broadly of the overall portfolio, we're valued at EV to EBITDA ratio of 11.3 times. If you look at our peer group, they're all much higher multiples, and that's partly a function of our lower mid-market focus, also because we don't like paying up for companies. The good thing is that means that because it's a modest valuation, we don't have to wait for somebody to offer an outrageous price to make it worth selling. And the gearing is quite modest. It's 3.4 times debt to EBITDA, which is, that's less than a third of the capital structure. So although they are management buyouts, they're not highly geared structures. Looking at the distribution by sector, the key points here, as I mentioned earlier, is we've got a lot in healthcare and information technology, which together account for nearly half the portfolio. But we've also got significant amounts in industrials, consumer, financial services. So private equity is a risky asset class. The only realistic way I know of reducing that innately high risk to acceptable levels is through maintaining a well-diversified portfolio, and that's what we have here. That's what we've built up over the years, and that's what we will maintain. It is a key source of strength for the business and a source of its returns. Some sectors are out of favor, others will come into favor. And basically, just to conclude here. 2024, we made some progress after quite a challenging period. We think the ingredients for recovery are in place. There is quite a bit of uncertainty, and that obviously affects confidence. So once confidence picks up a bit, we think the building blocks for more sustained recovery are there. And now is the time to be taking position, to build your position before that full confidence kicks in. The shares in this sector tend to go up when the market is in a sort of risk-on mode, and similarly or conversely languish when the market is in a risk-off mode. And it's in a bit of a risk-off mode at the moment because of all these the prospect of quite significant trade war and other things going on. As I mentioned, realizations were up nicely. We've continued to exit at good levels. We've made new investments in funds and co-investments, laying the future foundations for the business, and the balance sheet's strong, and we've got a great portfolio. So we're confident we'll continue to grow value for shareholders in the short and longer term. So that is the end of the presentation. So hopefully there are a few questions, and we've still got a reasonable amount of time.
Great. Yeah, thank you so much, Hamish and Andrew. And yeah, we do have quite a few questions, so thank you for everybody's engagement. So I'll kick off. The very first one, which was pre-submitted, so it's only fair to ask that one first. Does the size of the trust limit your ability to gain exposure to the smallest funds?
No, I mean, I would have asked that question the other way around, actually, which would be that does the size of the trust limit its ability to gain exposure to larger funds? Well, in both counts, not really, because we have obviously a range of fund positions. I mean, our typical unit size when we're going into a new fund is between about £5 and £10 million. Occasionally, we'll do more than that, sometimes less. The funds that we're typically investing in are lower mid-market funds. They're typically hundreds of millions rather than billions. I mean, there are exceptions, but they're typically hundreds of millions. And so, 5 or 10 million when you're building a book of investors is a worthwhile amount of money. But also we are, we're essentially what people would term smart money. They like us to come as an investor into their funds because bluntly, other people will follow because they will think, they're specialists in the lower mid market. They've got a good track record. If they're backing the fund, maybe we should think about doing it as well. And for the really big funds, the same applies, that, as professional investors who specialize in investing in private equity funds would tend to build a good relationship with the manager, even of large funds. And so we can get into those also. I mean, if the the minimum ticket size to invest in a fund is 50 or 100 million, then we won't be interested. Generally, if a private equity fund gets to the stage where it's specifying that type of minimum investment size, it's probably suffering from hubris. So that is another good reason not to get involved. Hopefully that answers the question.
Yeah, great. So moving on to discounts and the share price, because there's been a few questions about that. And if I summarize, and I know you alluded to some of it, especially in that last slide, but a few people have asked, why do you think the share price hasn't improved as you had predicted in previous presentations? And another person, for example, is just asking, do you think people are focusing too much on wide discounts, even though your company's performance has been very strong over the last decade or so? How do you think those things will marry up going forward?
Yeah, I mean, it's been frustrating that the discount has remained as wide as it has. I mean, it has been a bit volatile. If you look at the share price in recent weeks, it has been a bit volatile. Our discount, believe it or not, is actually quite narrow compared to our direct peer group. And we think a lot of that's to do with the dividend policy. So we're obviously going to maintain that dividend policy at all costs. The best way to narrow the discount is to basically encourage fresh buyers. So, speaking to the wealth managers, getting in touch with the platforms is critical, and also servicing our institutional investor base and adding to that as well. All these things come together. I did mention that there is this risk on, risk off kind of atmosphere that has quite a big effect on the discount. We thought in November that there was a possibility that the changes in the US could lead to a kind of stronger kind of stock market environment globally, but that was before all these tariffs were sort of brought into the forefront of people's minds, and these things could actually have some quite adverse impacts on a number of companies, and it's certainly putting people off doing deals. And our bit of the stock market is not immune to that. Having said that, there's a great opportunity here with the discounts at these levels. So we've got, I think, good prospect of some acceleration in NAV growth over the next couple of years, a more positive environment in the stock market, and continuing support for private equity could well lead to a big reduction in discount. But if I could predict that precisely, that would be quite surprising. But I think over the medium term, the discount should narrow. If you look at the long-term trend, we have been at a premium before in the past. Believe it or not, we've been at a premium twice. The most recent time was just actually before COVID. We were at a premium to NAV. We were on a strategy day with our board. We were discussing how we might issue stock with our company broker, and then somebody said, there's some virus that's come out in China and the stock market is collapsing. And that was on the actual day that we were contemplating what to do with our premium rating, which evaporated as we sat there. So hopefully we'll get sort of normalization of the environment, and we will be able to get to a premium. Okay.
Christine, I think you're on mute. No, you're still on mute, sorry.
I think
That's
there
it.
was clicking. Yeah, apologies. I'm back now. So a few related questions to the discount. One person has commented that maybe institutions are drifting more towards private markets, presumably accessing them in different vehicles, like less liquid vehicles than this. So how will that potentially impact CTPE? And they're alluding to the question about attracting more retail investors, and they've said, apart from Investor Meet Company, which we're doing now, what else are we doing? And maybe even if I just start from the distribution side of things, where I work very closely with the marketing team, and there is a very big focus on the retail investor, especially as it makes up nearly over half, I believe, by 55% of the share register. And so we are very conscious of making sure there's new and updated content available on the website, trying to disseminate that through other channels, whether it's through, say, the other big retail investment platforms, and other kind of publications that focus on investment trusts, whether it's Quoted Data or some of those ones. And we also do regular updates through the Kepler, or the website is Trust Intelligence website. So we're trying to come up with more and more ways, and the board are very aware of this need to ensure all shareholders are kept up to date and encouraged to invest in this type of asset class. But I'll hand over as well to Andrew and Hamish to comment further.
Yeah, there's no sort of magic bullet. We have to get out there and persuade new people to buy the shares. Institutions can buy these shares as well as retail investors, and we have several institutional investors who will sometimes hold this as a complement to what they might have in a limited partnership fund. But obviously, if they're in a limited partnership fund, they can't trade in and out of it in the way that they can in our shares. And also the disclosure and the governance, etc., within an investment trust is excellent. So I think the only reason an institution probably wouldn't get involved in our shares is if their unit size was enormous. If they literally did have a sort of 100 million unit size, which some of them do have, it's a bit difficult to buy a position in a 500 million company. Having said that, anyone significantly, below that can manage it quite easily. So institutional investors are very welcome alongside, the retail investor. I mean, from the retail investor's point of view, it's extremely difficult to get proper exposure to private equity, and you basically will struggle to find safe ways of doing private equity. And this is one of them, where you've got a well-diversified portfolio, good long-term track record, liquid shares, proper board of highly skilled directors. So you don't have to take a massive risk, but you can get excellent returns. So this, we think, is quite heavily overlooked by a lot of the IFAs and others who basically are not used to buying investment trust shares for various reasons historically. And we think that ultimately there should be a lot more money going into private equity investment trusts. They've got as I said, they've got the track record, they've got the portfolios, they've got the management. If the liquidity is there, and obviously it's a lot more liquid than something that's completely illiquid, they should buy. But we can't assume that will happen. We've got to go out there and do things actively to persuade them.
Yeah.
Christine, so I was just going to comment on the flow of capital to private equity. I think it's worth commenting that is very much a positive for the company. Most of that capital is flowing into the very big funds, and they are natural acquirers of our portfolio once they've been professionalized and grown. We've always sold about 50% of the portfolio to private equity, larger private equity. So I think that's very positive.
Yeah, that's an interesting way to look at it. And funnily enough, Hamish, you also touched on something about bigger institutions maybe finding it more difficult to buy this type of trust. A shareholder has asked about the F&C investment in private equity, and obviously a lot of it is through your team, but they're wondering, has it ever been considered that F&C would actually buy this discounted investment trust to gain exposure to private equity? But you may have answered it already, just in the sense of sheer size.
Yeah, we obviously run a portfolio of about 400 million for the F&C investment trust, which is quite a similar portfolio. It's a bit more concentrated, but it's similar to what we have within private equity trust. We obviously work with them very closely. The short answer is yes, it has been considered. In fact, a number of years ago, there was a large stake available, and they were offered it. But as you might understand, investment trusts are quite nervous about buying significant stakes in other investment trusts within the same management group, even when it makes complete and utter investment sense. And I think on that occasion, which is quite a long time ago now, it was about 15 years ago, that was the kind of that was the thing that deterred them from doing it. But there's no actual strong reason why they shouldn't do it.
Mm-hmm. Okay, super. There's a question about comments about realizations and how they've had strong returns. What's the current average expected multiple across the portfolio?
Well, in terms of the multiple of when we realize?
Yeah, I think so. And
yeah. We did last year, it was 4 point something. So that's good. I mean, that's that was 4.3 times. and that was over 48 exits. So, that is excellent. When private equity is selling, I mean, they're typically aiming for at least 2.5 times money. So anything above that is pretty good. We have achieved that pretty well in recent years. I mean, if you look at our long-term track record that includes absolutely everything, the money multiples are well over 2 times, and the IRR is in the high 20s.
Mm-hmm.
When we're making new investments, co-investments, for example, we will not buy anything unless we are very confident that we can do a net IRR of 25%, which is quite a high hurdle. So lots of things fall by the wayside at that point. And the satisfying thing is that long-term track record does bear that out, that we do achieve that, and that's over hundreds of deals, basically.
Mm-hmm. Yeah, and on that topic as well, how many of the realizations, if any, were loss-making in 2024?
Not very many, actually. Andrew might want to chip in on this. I mean, occasionally there are software companies that are not yet break even, but most of them, by the time they get to the point of exit, would be profitable. But Andrew, have you got any idea for the number of loss-making exits?
I don't know the exact stats offhand. No.
Right. I don't think it's very many, actually. I mean, most of them are being priced on a multiple of EBITDA. Now, sometimes particularly in the software sectors, they're priced on a multiple of revenue. Now, that doesn't necessarily mean they're not profitable, but what they describe as the valuation metric can be a multiple of revenue. But most of these exits, the vast majority, would be profitable at the point of exit. But that's why people want to buy them, because they actually have got profits.
Yeah. And what's the average holding period of the investments? What percentage of the portfolio is longer than that as it stands? And what's their average IRR?
I haven't got the precise stat, but I'm going to say it's about 5.5 years is the average holding period.
Mm-hmm.
And you could actually, if you looked at the chart, which was earlier in the presentation, 2/3, 64% is 4 years old.
Yeah, it's on slide 31.
Yeah, 4 years old,
And
or greater. It's more than 4 years old. No, it's 3 years. Sorry, 46% is over 4 years old, and then it'd be a smaller percentage that's more than 5.5 years, if you like.
Mm-hmm.
And we've done quite a bit of analysis of the kind of older exits. And what's really encouraging to see is even when the company's been held for quite a long period of time, we do tend to get that uplift on exit. And also we get some really great results.
And on that topic, how is 2025 looking in terms of realizations?
Yeah, well, so far, I mean, first quarter was only just finished. There's been a certain amount of activity. There's quite a bit, quite a few sort of pregnant deals, if you like, where they haven't happened yet, but they're moving forward. So I think, given the current environment, which, as I mentioned, is still quite uncertain, I think it's looking pretty healthy. Actually, there's quite decent two-way business.
Mm-hmm. And this is an interesting question about, well, it's quoting another private equity investment trust who sold a bundle of mature funds at a 5% discount, realizing 62 million. Is this something that CTP might consider or has done in the past?
Well, we've only ever sold in the secondary market once, and that was in 2009, and that was done because we had to demonstrate to the market that we could sell things without taking a big discount, because they were right in the middle of the financial crisis. So you could say that was very much a last resort, and it's not something I'd really want to repeat, where you have to give up any significant amount of value. So in the instance you're talking about, so that they're handing over a chunk of their portfolio at 5% below the valuation. Now, we've just explained that the valuation is naturally conservative, and if you hold them to fruition, you should get significantly more than that. So I think the argument there would be that either they needed to de-gear, or they had alternative uses of that money, however much they got in, and they felt they could make a substantial and quite quick return with the cash that they brought in. So there is a circumstance where it might make sense, but selling significant chunks of our portfolio below net asset value is always going to be, in the short term at least, at the expense of our shareholders. So we'd have to think extremely carefully about that. It'd have to be a pretty good argument in favor of it.
Mhm.
I think potentially one of the reasons they might have done that is to demonstrate to the market that the discounts applied to these trusts is not justified. But yeah, it does have an impact to the NAV.
Looking at the increased weighting to co-investments, how does that benefit the balance sheet? They're asking about the outstanding commitments. Does that tend to come down with the increasing share of co-investments?
Yeah, we've been at this sort of level of co-investments for quite a few years, for low 40s. The plan is to get up to 50%, but we keep selling things before we get there. So, that's not a bad thing. So I think, so in recent years, the level of commitments as a proportion of NAV has been, around about 40% or so, and we don't see that changing dramatically. But if we didn't have any co-investments and it was entirely funds, then you'd expect they would probably be running with a higher level of commitments.
Yeah, and I think you've answered this in previous occasions, but somebody's asking, what criteria do you use when differentiating between direct and co-investor investments?
Between direct and
maybe between co-investments and fund investments, maybe.
Right. Yeah, because the co-investments are direct investments. It's just that they're led by another private equity house. So we have full access to all the information that the lead private equity house has. So we basically are looking at all the same criteria as the lead private equity house would, and everything else that we require in our own investment process. So you're drilling right down to the company, you're meeting the company, you're writing a paper up on it. And as we said, we've got this 25% net IRR threshold. Now, if we're looking at a fund position, that's obviously more about assessing the manager rather than the company, although we do look a lot at the underlying companies that they've invested in, because that tends to illustrate their strategy and their preferences, and also act as examples of their previous work and skill. But we have we won't invest in a fund unless for sure we could do a net 20% IRR at the whole fund basis. That's a wee bit lower than for a co-investment, because you've got to take into account the additional costs of the fund.
And I know it's 11:30, but maybe because there have been so many questions, we could keep going if that suits you, just even for another 5 or 10 minutes. Right. So on a macro outlook, somebody is asking about your view about concerns on a possible UK recession. Because UK is your largest exposure, how concerning would it be for the fund, and would this change your approach?
This company has been going for 25 years, so it's gone through lots of different economic environments, and it's proved resilient. It's been able to keep going successfully. private equity is an absolute return asset class. So, we're not chasing an index or anything. We're trying to make, good, strong, absolute returns. Private equity does not have to invest if they cannot find enough investable companies at the right price. So you can have periods which are less active and other periods that are more active. We're not like a listed fund manager who has to be 100% invested in the stock market all the time. So these are significant differences. The key thing for us is that the UK market, which is our sort of main or largest individual market, should continue to be an attractive place for people to invest. Should have a enterprising economy that's appropriately supported by the government of the day, whoever they may be. So obviously there are going to be fluctuations in policy, but the history of this company has been that we've gone through a dot-com bubble bursting, we've gone through a financial crisis, we've gone through a Eurozone crisis, we've gone through a pandemic, and out the other side, and yet we've still been able to deliver very good returns. So I know it's quite interesting. We all like to sort of focus on it in a lot of detail, but we're not expecting a deep recession or anything like that. I mean, it's possible we might have a technical recession. I mean, the economy was growing at quite a reasonable rate until the middle of last year, and then it stalled for a bit. So we would very much hope that stalling would stop, and then we could get some new momentum into it. That is about confidence, investor confidence, business confidence. And I think the current government are probably realizing that now, and they will probably try and do things that will improve that level of confidence.
Yeah, hopefully. I could try to sugarcoat this, but I won't. There is somebody who's asked, Hamish, I hope you are not trying to retire, introducing your co-manager. If you just maybe have a couple of comments on that.
Well, I mean, I've got this beard at the moment, so it probably makes me look even older. And this is, by the way, it's not a permanent feature, actually. I've actually been off. I've been off work for a bit because unfortunately I broke my leg, my femur. It wasn't skiing or anything. I slipped on a wet floor when I was on business in London, and had 6 days and 10 days in hospital, and I've had several weeks recovering. So basically, that's why I've got the beard. Actually, it's not because I'm ancient and past it. So no, Andrew is the deputy manager. He's been working with me for many years, and he's been working very closely on this trust for ages. And none of these investment vehicles are run by one-man wizards. Yes, there are experienced people involved. It's a team effort, and there's several people behind myself and Andrew who all contribute to this. So I know it's comforting having a kind of well-kent face in front, but it is going to be this well-kent face, for some time yet.
Great. And keeping on the theme of the firm as a whole, or Columbia Threadneedle, somebody's asking, has the AUM managed by your team increased since moving to Columbia Threadneedle from BMO?
It's been pretty stable, actually. I mean, it probably has gone up a bit because we've done a bit more for the Foreign Colonial Investment Trust. I mean, one thing that did cause it to go down was that the Canadian business that was part of our business was left behind in Bank of Montreal. That's a long story, but so that was a bit of a kind of step back. But otherwise it's been stable or growing, and we've got new funds in market. So when those funds are launched, the AUM will grow quite nicely.
Mm-hmm. Then there's a question about the bid-ask spread. So is there anything that can be done about the size of the bid-ask spread? This has to, they're just suggesting that it can be a hurdle to attract new investors.
Yeah, you probably need to speak to our brokers about that. I don't think it's particularly out of kilter with other vehicles in this sector, and I think you're likely always to deal well within the spread. When there's a limited amount of stock around, the spread will be wider, obviously. So I'm not quite sure what I can say I can't say that we're going to be able to close that spread tightly, but you should be able to deal well within it.
Yeah, and well, another related question is just regarding the share price a few weeks ago, which hit 530p and then declined rapidly again. But that again could be down to the external conditions of the market, or
well, there was a specific reason for that, which was that there was a reinvestment of the dividend. I mean, basically, most of the people in our savings plan elect to have their dividend reinvested at the end of just as the dividend is paid, which is typically at the end of those quarters. 31st of January, I think, was the day for that one, and our broker manages the purchase of shares using that dividend money. And on this occasion, the market was extremely tight, and that pushed the price up. So that's unusual. It's not normally like that. So that's why it went up sort of 30p and came rattling down again. So our broker did actually call me up and give me quite a long, detailed explanation / apology for why that had happened.
Mm-hmm. That's reassuring. Then I think just one or two more questions. The revenue growth that you mentioned is very high. I think, Andrew, you were talking about that, the 20% level. The question is, how much does that come from M&A, if any?
Yes, so that is a combination of organic growth and M&A together.
Okay. Yeah. That's great. And then I think this even leads in nicely to closing remarks. Somebody has said, what would you say to long-term holders who are sitting on a decent capital return and have had a big chunk of capital returned through dividend that might encourage them to buy more stock now? And this was asked by a bearded investor as well.
Another bearded one. I mean, there are some out there actually. It's not banned. I would encourage them to buy. I think the key thing is to be in the market, and the reinvesting your dividend is an excellent way of just adding to your holding. You're doing it every quarter. Some quarters the price will be high, others it will be lower. But if you look at the long-term trend, you're on a long-term rising trend. So if you don't need the money, it's an excellent place to deploy it. So I would always recommend people to reinvest their dividends if they possibly can. You're normally going to be buying in at a discount to NAV, so by definition you're getting in cheaply, and that does enhance your overall return over the long term quite nicely.
Yeah, so I'll just hand over to any closing remarks if you want to just summarize, as you nicely did there, about a good time to buy, but maybe even just summarizing anything else that you'd like to leave investors with.
Yeah, look, I mean, as we go into 2025, as we said at the beginning, the ingredients for success are there. Some of the indicators have moved in the right direction. The ingredient that needs to be sort of strengthened, if you like, is the confidence thing. Now, there's every reason to believe that will come back, and we have a record of doing well under all sorts of different economic environments. Us as a team, but also the industry in general. So we think everybody should have some private equity in their portfolio, and this is one where you can buy the shares, you can get good long-term capital gain, but you also get substantial dividend in between. And this is a good time. We're at the beginning of 2025. I think 2025 will be a better year for this company than the last couple of years. And so I'd just like to thank you all for your interest and your support, and hopefully you can stick with us. Thank you very much.
Perfect. Hamish, Andrew, Christine, I'd just like to thank you for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.